Welcome. Today we're diving into the world of fintech, focusing on two popular fundraising methods, ICOs and STOs. These terms have become buzzwords in the digital finance space, but what do they really mean? As technology transforms the financial industry, new ways to raise capital have emerged, challenging traditional models. ICOs and STOs are at the forefront of this change, offering unique opportunities and risks. In this video, we'll break down what each term stands for, how they work, and why they matter in the context of fintech. Let's start our journey by understanding the basics. ICO stands for initial coin offering. Think of it as a digital version of an IPO, but instead of shares, companies offer digital tokens. These tokens are usually built on blockchain platforms like Ethereum. Investors buy these tokens, often with cryptocurrencies such as Bitcoin or Ether, hoping that their value will rise as the project succeeds. ICOs gain popularity for their simplicity and global reach, allowing startups to raise funds quickly from a wide audience. However, they also come with significant risks as the regulatory environment is still evolving. In ICO, a company creates a white paper outlining its project, goals, and how the funds will be used. Investors review this information and decide whether to participate by sending cryptocurrency to the project's address. In return, they receive tokens that may have utility within the project's ecosystem or could be traded on exchanges. The process is typically fast and open to anyone with internet access, making it attractive for both startups and investors. However, the lack of regulation means there's a higher risk of scams or failed projects. ICOs offer several advantages. They provide startups with access to global capital without the need for traditional intermediaries like banks or venture capitalists. The process is often faster and less expensive than traditional fundraising. For investors, ICOs can offer early access to innovative projects and the potential for high returns. The use of blockchain technology also brings transparency to transactions. However, these benefits come with their own set of challenges, which we'll explore next. Despite their advantages, ICOs are not without risks. The lack of regulation means that investors have little protection if a project fails or turns out to be fraudulent. Many ICOs have been associated with scams leading to significant losses. Additionally, the value of tokens can be highly volatile and there's no guarantee of success. Regulatory bodies around the world are starting to pay closer attention, but the landscape remains uncertain. It's important for investors to conduct thorough research before participating in any ICO. STO stands for Security Token Offering. Unlike ICOs, STOs issue tokens that are backed by real-world assets, such as equity bonds or real estate. These tokens are considered securities and are subject to regulatory oversight. STOs aim to combine the benefits of blockchain technology with the protections and requirements of traditional finance. This makes them more appealing to institutional investors and those seeking a safer investment environment. Let's look at how STOs work in practice. In STO, a company creates digital tokens that represent ownership or a stake in a real asset. These tokens are issued in compliance with securities regulations, which means investors must meet certain requirements, such as being accredited or passing KYC checks. The process involves legal documentation and oversight by regulatory authorities. Investors receive security tokens that can be traded on specialized exchanges, offering liquidity and transparency. This structure provides greater protection and confidence for both issuers and investors. STOs offer several key advantages over ICOs. By adhering to securities regulations, they provide a safer environment for investors. The backing of real assets adds intrinsic value to the tokens, reducing volatility. STOs also open the door for institutional investors who require regulatory compliance. The use of blockchain technology ensures transparency and efficiency in transactions. Overall, STOs aim to bridge the gap between traditional finance and the new digital economy. While STOs offer more security, they also come with their own set of challenges. The regulatory process can be complex and costly, requiring legal expertise and compliance checks. This can slow down the fundraising process and increase expenses for issuers. Additionally, the market for security tokens is still developing, which may limit liquidity and trading options. Despite these hurdles, STOs are gaining traction as a more reliable alternative to ICO. Now that we've covered the basics of ICOs and STOs, let's compare the two. ICOs are generally faster and more accessible, but they come with higher risks due to the lack of regulation. STOs, on the other hand, offer greater security and investor protection, but require more time and resources to launch. The choice between the two depends on the goals of the issuer and the risk tolerance of the investor. Both have their place in the evolving fintech landscape. Regulation plays a crucial role in the world of token offerings. While ICOs often operate in a legal gray area, STOs are designed to comply with existing securities laws. This means that STOs are subject to oversight by financial authorities, which can vary from country to country. The regulatory environment is constantly evolving as governments seek to balance innovation with investor protection. Staying informed about these changes is essential for anyone involved in fintech. From an investor's point of view, ICOs and STOs offer different opportunities and risks. ICOs can be attractive for those seeking high returns and willing to accept greater risk. STOs, with their regulatory backing and asset support, appeal to more conservative investors or institutions. Understanding your own risk tolerance and investment goals is key when choosing between these options. Both models have the potential to reshape how we think about investing in the digital age. Companies looking to raise funds, the choice between an ICO and an STO depends on several factors. ICOs offer speed and lower costs, but may limit access to certain investors and markets due to regulatory uncertainty. STOs require more preparation and legal compliance, but can attract a broader range of investors, including institutions. Issuers must weigh the benefits and challenges of each approach to determine the best fit for their project. Both ICOs and STOs rely on blockchain technology to issue and manage tokens. Blockchain provides a decentralized, transparent ledger that records all transactions. This technology reduces the need for intermediaries, lowers costs, and increases efficiency. It also enhances security by making records tamper-proof. The use of blockchain is a key factor in the rise of digital token offerings and the broader fintech revolution. Smart contracts are self-executing agreements coded on the blockchain. They play a vital role in both ICOs and STOs by automating processes like token distribution and compliance checks. This reduces the potential for human error and increases trust among participants. Smart contracts also enable complex features, such as vesting schedules or dividend payments, making token offerings more flexible and efficient. One of the most exciting aspects of ICOs and STOs is their global accessibility. Anyone with an internet connection can participate, breaking down traditional barriers to investment. This opens up new opportunities for startups to reach a worldwide audience and for investors to access projects from around the globe. However, it also introduces challenges related to cross-border regulations and compliance. Key distinction between ICOs and STOs lies in the type of token issued. ICOs typically offer utility tokens, which provide access to a product or service within a project's ecosystem. STOs, on the other hand, issue security tokens that represent ownership or rights to an asset. Understanding the difference is crucial for both issuers and investors, as it determines the regulatory requirements and potential uses of the token. STOs are required to comply with Know Your Customer (KYC) and anti-money laundering (AML) regulations. This means that investors must verify their identity and source of funds before participating. These measures are designed to prevent fraud and ensure that only eligible investors can buy security tokens. While this adds complexity to the process, it also increases trust and safety in the market. Liquidity refers to how easily tokens can be bought or sold on the market. ICO tokens are often listed on cryptocurrency exchanges, providing immediate trading opportunities. STO tokens, due to regulatory restrictions, may have limited trading options and are usually listed on specialized security token exchanges. As the market matures, liquidity for security tokens is expected to improve, making them more attractive to investors. Let's look at a real-world example of a successful ICO. Ethereum, one of the most well-known blockchain platforms, raised funds through an ICO in 2014. Investors received Ether tokens, which have since become a major cryptocurrency. The success of Ethereum's ICO demonstrated the potential of this fundraising model and inspired countless other projects to follow suit. However, not all ICOs have been as successful, highlighting the importance of careful evaluation. STOs have also made an impact, particularly in real estate. For example, a company might tokenize ownership of a property, allowing investors to buy security tokens that represent shares in the asset. This approach increases liquidity and opens up real estate investment to a broader audience. The use of blockchain ensures transparency and simplifies the process of buying and selling property shares. Most ICOs and STOs use established token standards, such as ERC20 or ERC1400, on blockchain platforms like Ethereum. These standards ensure compatibility with wallets and exchanges, making it easier to manage and trade tokens. The choice of platform and standard can affect the security, functionality, and adoption of the token. Staying updated on the latest developments in token standards is important for both issuers and investors. Exchanges play a vital role in the token ecosystem. They provide a marketplace for buying and selling tokens, offering liquidity and price discovery. While ICO tokens are typically listed on cryptocurrency exchanges, STO tokens require specialized security token exchanges that comply with regulations. The growth of these exchanges is crucial for the development of the token market and the success of future offerings. Token custody refers to the safe storage of digital assets. As the value and importance of tokens grow, secure custody solutions become essential. These can include hardware wallets, custodial services, or even regulated financial institutions. Proper custody protects investors from theft, loss, or hacking, and is especially important for STOs, which may have additional regulatory requirements. Both ICOs and STOs can have tax implications for issuers and investors. The treatment of token sales varies by jurisdiction and may involve capital gains, income, or other taxes. It's important to consult with tax professionals and stay informed about local regulations. Proper tax planning can help avoid unexpected liabilities and ensure compliance with the law. The future of ICOs and STOs is closely tied to the evolution of fintech and blockchain technology. As regulations become clearer and technology advances, we can expect new models and innovations to emerge. Hybrid offerings, improved security, and greater adoption by mainstream investors are all on the horizon. The ongoing development of token offerings will continue to shape the financial landscape for years to come. Fintech is driving innovation across the financial sector, and token offerings are a key part of this transformation. By leveraging technology, fintech companies are making fundraising more accessible, efficient, and transparent. This democratization of finance empowers both issuers and investors, paving the way for new business models and opportunities. The synergy between fintech and tokenization is set to redefine how we think about finance. As with any emerging technology, there's a risk of overhype in the token offering space. Not every project will succeed, and some may be driven more by speculation than real value. It's important for both issuers and investors to remain cautious, conduct due diligence, and focus on projects with solid fundamentals. Learning from past mistakes can help the industry mature and avoid repeating costly errors. Advisors play a crucial role in the success of token offerings. They provide expertise in areas such as legal compliance, technology, and marketing. A strong advisory team can help navigate regulatory challenges, design effective tokenomics, and build investor confidence. Choosing the right advisors is a key step for any company planning an ICO or STO. Building a strong community is essential for the success of any token offering. Engaged communities can provide valuable feedback, spread awareness, and support the project's growth. Many successful ICOs and STOs have relied on active online communities to drive adoption and maintain momentum. Effective communication and transparency are key to fostering trust and long-term support. Effective marketing is vital for attracting investors to ICOs and STOs. This includes clear messaging, educational content, and targeted outreach. Social media, online forums, and industry events are common channels for promotion. However, marketing must comply with regulations to avoid misleading claims or illegal solicitation. A well-executed marketing strategy can make the difference between a successful and unsuccessful token offering. Tokenomics refers to the economic model behind a token, including its supply, distribution, and utility. Well-designed tokenomics can incentivize participation, ensure fair distribution, and support the long-term success of the project. Both ICOs and STOs require careful planning of tokenomics to align the interests of issuers and investors. Poorly designed tokenomics can lead to instability and loss of confidence. Legal documentation is a cornerstone of any token offering, especially for STOs. This includes white papers, terms and conditions, and regulatory filings. Proper documentation ensures transparency, sets expectations, and provides legal protection for all parties involved. Working with experienced legal professionals is essential to navigate the complex regulatory landscape and avoid costly mistakes. Robust technology infrastructure is critical for the success of ICOs and STOs. This includes secure smart contracts, reliable blockchain platforms, and user-friendly interfaces. Technical glitches or security vulnerabilities can undermine investor confidence and jeopardize the project. Investing in strong technology and regular audits helps ensure a smooth and secure token offering process. Token offerings often attract participants from around the world, making cross-border legal and regulatory issues a key concern. Different countries have varying rules regarding token sales, investor eligibility, and tax treatment. Issuers must carefully navigate these complexities to avoid legal pitfalls and ensure global compliance. Consulting with international legal experts is highly recommended. Educating investors is crucial for the healthy development of the token market. Many participants are new to blockchain and digital assets, so providing clear, accessible information helps them make informed decisions. Educational resources can include guides, webinars, and FAQs. Well-informed investors are more likely to support legitimate projects and avoid scams. Security is a top priority for any token offering. This includes protecting investor data, securing smart contracts, and preventing hacking attempts. Regular security audits, bug bounties, and strong encryption are common practices. A single security breach can damage a project's reputation and result in significant losses. Proactive security measures are essential for building trust and ensuring long-term success. Transparency is fundamental to building trust in token offerings. Projects should provide regular updates, disclose financial information, and be open about risks and challenges. Transparent communication helps investors feel confident and engaged. Trust is the foundation of any successful fundraising effort, and it's especially important in the fast-evolving world of fintech. Regulatory trends in the token offering space are constantly evolving. Governments and financial authorities are working to create frameworks that balance innovation with investor protection. New laws and guidelines are being introduced, and staying compliant is a moving target. Both issuers and investors must stay informed about regulatory changes to navigate the market successfully. Hybrid offerings combine elements of both ICOs and STOs, aiming to capture the benefits of each. These models may offer utility tokens with some security features or vice versa. Hybrid offerings are still experimental, but they represent an exciting area of innovation in fintech. As the market matures, we may see more projects adopting hybrid approaches to meet diverse investor needs. Institutional investors are beginning to show interest in token offerings, especially STOs. The regulatory compliance and asset backing of STOs make them more appealing to large investors such as banks and funds. Institutional participation can bring more capital, credibility, and stability to the market. Their involvement is a sign that token offerings are moving toward mainstream acceptance. Token offerings have the potential to promote financial inclusion by making investment opportunities accessible to a wider audience. People who were previously excluded from traditional finance can now participate in global markets. This democratization of finance is one of the most promising aspects of ICOs and STOs, helping to close the gap between different economic groups. As token offerings grow, so does the need to consider their environmental impact. Blockchain networks, especially those using proof of work, can consume significant energy. Projects are exploring more sustainable alternatives such as proof of stake or eco-friendly blockchains. Balancing innovation with environmental responsibility is an important challenge for the future of fintech. The journey of ICOs and STOs is just beginning. As technology, regulation, and market dynamics evolve, new opportunities and challenges will arise. Staying informed, adapting to change, and focusing on transparency and security will be key to success. Whether you're an investor, issuer, or simply curious about fintech, the world of token offerings promises to remain dynamic and full of potential. Wrap up: ICOs and STOs represent two distinct but related approaches to raising capital in the fintech era. ICOs offer speed and accessibility, while STOs provide security and regulatory compliance. Both have their strengths and weaknesses, and both are shaping the future of finance. As the industry matures, we can expect continued innovation, greater adoption, and a stronger focus on investor protection. Thanks for joining us on this exploration of token offerings in fintech.